Hey, good morning, everyone. Welcome to another edition of Value Added 101. This is a recurring webinar series where we touch upon small business development and value add entrepreneurship through a lot of different angles. And so we're really thrilled to have Spencer Dung of WestPac Wealth Partners here today. And before we get going, I'm going to share a brief snippet highlighting the work we're doing at the Waihoa Value Added Product Development Center. So I'm going to share my screen.
The Waihoa Value Added Product Development Center adds to the educational mission of community colleges. Hawaii has celebrated success in agriculture, and we want to support local agriculture by investing and growing the Made in Hawaii, Produced in Hawaii, and Processed in Hawaii brands. Resources available on site will support local entrepreneurs in improving their products and business models, reducing the need for businesses to leave Hawaii to become viable. We offer programming curtailed around value-added businesses, equipment that are unique to Hawaii and typically too expensive for small businesses. Provide consulting and know-how to help improve products, reduce cost of production, and increase shelf life, all critical to the success of local products and are now available in Central Oahu for statewide access through the community colleges. When we look at facilities that can help support scaling products, bringing new products to market, there's very few in Hawaii. Equipment like our hyperbaric chamber that will help stabilize shelf life for products. These are things that our entrepreneurs need so that their products can get into the store, so that their products can make that trip across the ocean. Keeping businesses local, supporting local agriculture, and strengthening local entrepreneurial pipelines are core to the mission of the Waihoa Value Added Product Development Center and the community colleges. I would love for you to learn more about what we are doing here by looking at our website and joining us for a tour so that we can continue strengthening Hawaii's local economy through agriculture.
All right. And so at the Waihoa Value Added Product Development Center, we're committed to supporting small businesses, small businesses as they work to launch and grow. And of course, a big component to that is the financial piece. So again, very thrilled to have Spencer. Spencer, tell us a little bit more about yourself. So you're a managing director and an advisor with WestPac. Tell us more about that and how you engage with small business.
Yeah, thanks, Chris. Excited to be here with everybody. As Chris mentioned, I'm with WestPac Wealth Partners. I'll tell you a little bit more about the firm as we go through our presentation today. But really, why I'm excited to be here is we're a local company as well. We're a financial planning firm that was founded here in Honolulu. So, just like all of you with your businesses, we're a business that started here and looking to grow. We created the firm specifically to work with small business owners, knowing that business is done very differently here in Hawaii than it is on the mainland. I did spend 10 years away, most of which was in San Diego. And we don't have the same large corporations necessarily that the bulk of businesses do on the mainland. And so it's about helping our entrepreneurs. It's about helping each and every one of you make smart financial decisions so you can grow, support your community, support your families, and ultimately help Hawaii just be better on a global stage. So that's really why I'm excited to be here and share what we can with you folks. And hopefully, you all can take something away and apply it and be better for it.
Awesome. Well, Spencer, I really just want to turn it over to you. I know you have a lot of information you want to share. So yeah, you take the wheel.
All right, cool. So I'm going to share my screen here. And Terry, it's great to see you. The rest of you, feel free to turn your cameras on. As you'll see, am very conversational in nature. So if you have questions, please feel free to jump in, take yourself off mute. I'll do my best to monitor the chat as well, but we'll see how that goes. Let me just make sure I'm sharing the right screen there. Yep. Chris, can you just give me a thumbs up? You can see the PowerPoint. Cool. So yeah, like I said, we put together a presentation today, and I know this is Value Add 101. So we really wanted this to be just sort of a foundational piece for what all small business owners should be thinking about as, maybe you're launching your business, maybe you're starting to grow your business. We do work with businesses of all shapes and sizes. So, if you're still like just maybe on theme. You were baking cupcakes for your child's class, and everybody said they're so good, you should start selling these. And it's still kind of a hobby slash idea, all the way through businesses that are, scaled and looking for exit. So we are going to focus more on that front end of the business, kind of starting, growing, and developing. I do have a little bit at the end about exit if anybody's there, but I think, Chris mentioned most of us are still kind of in that startup growth phase. So that's where we're going to spend most of our time today. But like I said, please do feel free to jump in, ask questions as we go. Um, I did also say I'd tell you a little bit about Westpac. I'm going to leave it very high level again, just so that you know who we are. We're a firm, like I said, started here in Honolulu in 2007. So we are relatively young in, the grand scheme of financial companies, but we made 18 years this year. So um, I'm a financial planner. I only have bad jokes. We never have good ones, but at 18, we're finally adults. So, we like to think we've figured some things out along the way. We've taken our bumps and bruises, but we're really excited to work with our local community. Um, in those 18 years, we've also grown. So we expanded to the mainland, which I think is pretty cool, being a local boy working for a finance company that's not from the mainland coming here, but actually from here going there. So we now have about 400 advisors across the country, primarily up and down the West Coast, WestPac, Western Pacific. That's kind of where we're primarily based, but we do have advisors as far east as New Jersey, Miami, Kansas City, Houston. So we have grown into a firm here that we've been fortunate to be recognized by some big names there as well. Um, Hopefully, we don't have any attorneys on the call, but this next slide is dedicated to our attorneys who tell me I have to put this in here. The really fun disclosures that nobody can ever read, but basically, the long and short of it is I am not an attorney. I did not go to law school. I did not pass the bar. I'm not a CPA. I did not pass those exams. I am a financial planner. We will talk about investments, insurance, tax, business. But again, I do have to disclose I'm not an attorney, not a CPA. So if you do have those professionals, please make sure you speak with them as well. But on to kind of today's discussions, right? I really want to talk a little bit about the realities of financial planning. What does that look like? Because I think there's a lot of misconceived notions out there. Everybody has an idea of what financial planning is. So we'll share with you what this means to us and how we work with our clients on that. We wanted to give you some building blocks to financial success. So these are just very high level things that everybody can take and apply and start thinking about. And then really kind of the bulk of our conversation going into some business planning concepts, tax planning, and then like I said, I'll just kind of breeze through the exit planning there as well. But like I said, please all along the way, feel free to jump in, ask questions as we go. Okay, so let's talk about the realities of financial planning. I think most of you on the call have probably planned for something in your life, whether it was a trip, whether it was, what you're making for dinner. And the reality is there's so many decisions that go into any type of plan, right? Where are you going to go? How are you going to get there? What are you going to do when you're there? Where do you stay, right? If we're planning a trip. My dad does a lot of the cooking for my family. He loves to go to every grocery store on the island because he'll tell you Times has the best this, Foodland has the best that, Safeway for this, right? So I can't imagine his planning of just a simple dinner menu, right? He's got to think about what he's making, where he's picking it up, right? Financial planning is the same, right? There are a lot of variables, a lot of components, a lot of questions, a lot of goals, a lot of things that go into creating a financial plan. And I think a lot of those things go overlooked because, maybe the media or nowadays social media, TikTok, YouTube, whatever it is, they focus on one area or another and say that that's all you need to know, right? That would be like, again, if I'm making dinner, all I have to do is make the protein, right? But what about starch? What about vegetables? What about dessert? What about all the other things that go along with it, right? And so, in reality, again, financial planning is very complicated. There are a lot of things that go into it, right? And I'm not saying this to try to scare anybody or be overwhelming, but it's just to say that, like, again, in our industry, sometimes people say, well, I have my retirement set up, so I'm good. Well, that's great. What about your taxes? What about your insurance? What about your real estate? What about your business, right? Oh, well, I don't have kids, so I don't need life insurance. Okay, well, what if that could enhance something else in your portfolio, right? So, again, just making sure we understand that financial planning, there's a lot to it. And it's not just one product, it's not just one area, it's really all of it put together, right? And it can be a lot. And especially for our business owners, I think unfortunately the financial industry has done a major disservice because what drives a relationship with traditionally with financial planners and their clients is a transaction. And that transaction is usually going to occur in one of two domains, either in your personal financial world, right? So, how do you save for retirement? How do you save for education costs or college for your children or grandchildren? Or it's going to be on the business side, right? How do you provide benefits to your employees? Do you have health insurance offered, right? It's that transaction, right? And where we operate here at Westpac with our clients is right there in that overlap or on the screen, that gray area between your personal and your business finances and vice versa, right? So as we go through the conversation today, we're going to talk about some opportunities that, as business owners you have that most W-2 employees don't have. So your friends, your family, your cousins, your aunties and uncles who work for somebody else, they may not get to make the same decisions you get to make as a business owner, right? For example, just at a high level, did anybody know as a business owner, you can choose how you're taxed? Did you know that? You can actually tell the IRS how you want to be taxed on your income. That's a decision you get to make. If I'm a W-2 employee, let's say I work for Hawaiian Airlines, I don't have a choice, right? I'm taxed as a W-2 employee. But as a business owner, you can make that choice, and that choice should be made strategically to benefit both your business and your personal financial world. I've worked with a lot of business owners over my career. Not a single one of them has ever said, "Hey, you know what I really want to do is build a super successful business and not be able to pay my personal mortgage and put food on the table for my family." Right? Like the business is important. It's what we grow and generate, our income from to benefit our family, our personal life, and what we want to do, and vice versa, right? So again, a lot of decisions that we can make strategically to try to do that. And that's where we operate. So on to kind of our building blocks of financial success. So if we're taking notes, I promise there won't be a quiz at the end. I hated that in my education, right? Like they don't tell you, and then it's like, oh, here's a quiz. No, no quiz. But if you're taking notes, these are the four financial building blocks we'd really love for you to write down. Again, very, very high level, just areas that everybody should be considering when it comes to making sense of all of those variables, making sense of all of the noise that we talked about. With the reality of financial planning. So the first one is financial organization. And for business owners, that includes the coordination of your advisors. The second is protection planning. Third, we have cash flow and efficient wealth management. And finally, long-term tax planning. So we're going to dive into each of those a little bit deeper here as we go. Okay. So the first one is financial organization, right? If you're comfortable using the emojis, if you could just raise your hand or put your hand up or give me a thumbs up or Terry, I can see you. Can everybody raise their hand if you've worked with a CPA or a tax professional? Give me a thumbs up. Okay, we got a couple, right? Hit it again if you've also ever worked with an attorney, or if you didn't work with a CPA, but you've worked with an attorney, feel free to raise your hand, give me a thumbs up, emoji, what have you. Okay. What about a banker? Somebody for loans, funding, financing, SBA, what have you. Okay. What about a mortgage broker? Anybody own a home? You've worked with a mortgage broker. Yep. Stephanie's been throwing up thumbs up, right? Real estate agent to buy that home, or maybe a commercial realtor to help get you some space. Okay. We're getting some more thumbs up. P&C, I think that's most of us, right? That's our auto insurance, our homeowner's insurance, our liability. Everybody work with one of those. Okay, cool. For those of you who raised your hand or threw me an emoji more than once, when was the last time all of those professionals were in the same room discussing your best interest all at the same time? Has that ever happened for anybody? No, I'm getting some head nods no from those I can see. Chat, never, never. Yep, right. Again, I've done this a lot of times. I'm still batting 100 on this. Not once ever have all of these professionals been in the same room at the same time to work with you on your behalf, right? It falls on you as the business owner to call your CPA and then call your wealth manager and then call your insurance person and then call, right? Like, so for us, financial organization, not just having the right people or having the right vehicles, right? It's great that you have your savings account, your bank accounts, your investment accounts, your insurance policies. Understanding what you have and where it is just half the battle, right? Understanding who those people are in your corner to help with that is still just half the battle. For us, it's about understanding how all of those pieces fit together, right? Because they all work together, right? Even though those professionals maybe don't talk to each other and they'll say, oh, well, I'm just the banker. I just help you get the money. You got to go talk to somebody else about what to do with it. Clearly there's an intersection there, and yet who's the person helping with that, right? And so again, that's kind of where we come in, is understanding not just what you have and where it is, but how do all those pieces work together to benefit you, right? And we can't even get these 6 people on the screen in the same room. What if we go to probably what most of your life looks like with a lot more people, right? Maybe you have a bookkeeper, maybe you have, somebody in your firm or outside of your firm who's helping with benefits. Again, we said property and casualty, but what about your life insurance, disability insurance, your insurance brokers, health insurance, again, your wealth managers, your 401k providers, right? Again, I'm not trying to overwhelm anybody. Maybe you don't have any of these people yet, but as you grow your business or personally, right, you end up being at the center of this, right? And you're playing this game of telephone. Maybe some of you can relate to this idea. Um, a lot of our clients come to us, they do have a tax professional. They have somebody who helps them file their taxes, try to find deductions so they can pay less in taxes. Because let's be honest, we all want to pay less in taxes. Right. And so we go to our CPA, we provide the financials, and they say, hey, you know what you should do? You should start a 401k or a retirement plan so you can deduct some of that uh, income and not have to pay taxes on it. You can save it for retirement. You can provide it as a benefit to some employees as well. That's a great thing. And then you, the business owner, go, great. How do I do that? That sounds like a wonderful idea. I'd like to do that. They say, well, you need to go find a financial advisor. And then you're like, okay, how do I do that? They're like, here's some names, people I've worked with. Go ahead and call them, see which one you like. You call the financial advisor. You're like, oh, I like you. Can we open the 401k? The financial advisor is going to say, sure. How much do you want to fund it? They're like, I don't know. I did this because my CPA told me I need to do it. Okay, well, you need to call your CPA back and then figure out how much to. Okay, you hang up, call the CPA. Hey, Mr. Mrs. CPA, the financial advisor said I need to talk to you about funding the 401k. They're like, well, that depends. What do you want to do? You should talk to the financial advisor. Okay, hang up, call the. Hey, Mr. Mrs. Financial Advisor, what do I do? Oh, did you talk to the CPA? Right, and we just play this really fun game of telephone, right? And that's just one example. That's taxes and retirement, right? But again, all of these people have questions and comments and concerns, and they're great at what they do. The problem is, again, nobody's coordinating that advice for you, right? And so what we've tried to do is to make life a little bit easier, right? You got enough on your plate figuring out what your next product is, how you're going to expand, dealing with staffing, whatever it is, right? Spending time at the product development center, enhancing your product, doing those types of things. The last thing you need to be doing is worrying about this, right? And so what we find ends up happening with business owners is either this doesn't get done because you just don't have the time, the energy, or maybe even the know-how to do it, right? Or it does get done and your business doesn't get to grow as much as it could because you're doing this instead of working in your business, right? And so what we try to do is take this traditional approach of how most people have worked with financial professionals, right? And say, can we create a more optimal structure? Can we pull you outside of the middle of this so that you don't have to have every conversation and do all that back and forth, right? So you can work in your business and know that you have a team of professionals that are helping you work on your business, right? And so that's where we've created the structure. Obviously, I put us in the center, but it doesn't have to be us, right? There could be other advisors out there who might do this. Um, I don't know too many of them, but if there are, that's fine, right? It doesn't have to be us. But the idea is, can you be pulled out of that? And the way we work with our clients is we basically become like their chief financial officer or their personal CFO, right? Understanding all aspects of your business from a tax, a risk, a wealth, a legal, and just a business growth and advisory perspective, so that when you have a question like, hey, should I hire an employee? Right? We can look at all those aspects and say, well, if you do, this is what that's going to look like. If you don't, this is what that's going to look like, right? We might also be able to say, maybe you don't want to hire an employee, but we hire an independent contractor instead. And here's the reasons why, from again, a tax, a risk, a wealth, a legal, and a business perspective, right? So that by the time it comes to your desk, by the time you're on the call, you know it's been analyzed from all these areas, and you don't have to call the 5 or 6 or 10 different people to get all of the information to then try to figure it all out, right? So again, for us, this is what coordination of advisors really means. It's not to say we're going to be all those people, right? I had to put in the disclosures. I'm not the attorney, right? So I can't draft the legal documents, but we can work with the attorneys to make sure we know what documents need to be drafted, what it should say, so that again, by the time it comes to you, all of that has been coordinated on your behalf, right? So that's what financial organization coordination looks like. Moving on to our second building block, right? Protection. Um, I grew up, like I said here, I was a pool rat, beach bum. I just loved being in the water. I still love being in the water. One of my favorite things to do as a kid was to try to build sandcastles, right? And if you've ever tried to build a sandcastle at the beach, you know that no matter how well you build that sandcastle, at some point the waves are going to win, right? The tides come up, they wash that away. And as a kid, right, you don't really understand that. I used to try to dig a trench, draw a line, build a moat, right, move it up further up the beach, whatever, run back and forth with my bucket. No matter what I did, right, I couldn't protect that sandcastle. Eventually, the tides won, right? Um, what if, though, we could draw that line in the sand financially? Right? And so our second building block for financial success is how do we draw that line, right? How do we protect not a silly sandcastle as a kid, but everything we've worked so hard to build for our families, for ourselves, for our team members, for our employees, for everybody who you support financially, right? How do we draw that proverbial line in the sand to protect everything you've built, as the screen says, so you can't lose what you've worked so hard to build, right? Um, our philosophy is that, you all do the hard work. It's our job to help you protect it because life happens, right? Those tides will come. Those waves are going to come. We want to make sure that when they do, they don't knock your sandcastle down, right? So a couple of the protection pieces we want to make sure everybody is aware about and thinking about, right? The first is liability coverage, right? We live in the great country of America where I have the right to sue everybody and anybody because if something goes wrong, it's not my fault. It's definitely your fault. And I'm going to sue you to prove it and make sure you pay for it, right? Again, financial planner. I'm bad joke, not a comedian, right? I'm being a little facetious here, but it's true, right? When things go wrong, litigation, liability, those are all things to consider. As business owners, it's especially important that we understand that and we're paying attention to that because that is one way that unfortunately we've seen people run into financial issues, right? And the attorneys will tell you it doesn't matter if you're right or wrong, right? You can sign all the contracts that say you can't sue me, and if somebody sues you, they're going to sue you, even if they signed the paper that said they wouldn't, right? So, do we have the right coverage, the protection, both legal documents, insurance policies? Again, this as the screen shows, right? That's your auto, your homeowners, your umbrella, your excess liability, your commercial general liability. If you're manufacturing, again, most of you, I'm going to make an assumption, are probably utilizing the Y&I Value Add Product Development Center. So whether that's food, beverage, some sort of good that you're producing and selling, there's a lot of different things that go into that. Terry, raise your hand. Do you have a question here, sir?
Yes.
Yeah.
Yeah. So that brings up to me a question about like the type of company. Like I chose LLC. Like I'm just barely like all this stuff. I'm like, oh yeah, I need to give like eventually I guess I'll be doing this kind of stuff, like
Yep.
working with different people.
Yep.
Um, but okay, so I chose the LLC
Hmm.
because with the assumption that I have that umbrella. Can you talk to me about or talk to like how that works, like the type of company that you have and
Yeah.
yeah.
Yeah, great question. So LLC is an entity structure, right? So for those, maybe some of you have created an LLC as well. That is part of liability protection, right? LLC stands for limited liability company, right? So the idea is part of it is creating a business to limit the liability if something happens on the business side that your personal side is not exposed and vice versa, right? So that is definitely a very popular business structure to choose for that very reason, right? To limit liability, and that is part of this. But typically that's not enough, right? Because what if your business, your LLC, maybe you've acquired assets, right? So that within the business there's money in the bank, there's inventory, whatever it is, right? And maybe an employee slips and falls while they're working for you and they're going to sue the business. It may be true that they can't come after, let's say, your personal residence because, again, those are separate, but they can sue the business for whatever the business owns, right? So again, it's creating a divide between personal and business, which absolutely we want to do. Even though I said in the planning perspective, we live in that overlap. On paper, we want it to seem like separate, right? But even within that business, then there is risk and liability we have to protect for. And then same thing on the personal side, right? If I'm driving home from work in my personal vehicle and I get in an accident, somebody could sue me and come after my personal stuff. They can't come after the business, right? So that's where, again, legal documents, insurance, those types of things come into play. And certainly, we can do a review and make sure you have the best protection you can, both structurally, like you said, with your business structure, but also with those other types of legal and insurance vehicles. Uh, Great question, right?
And
One of
then
the other
and
things we
then
have.
in
Oh,
addition to that, sorry.
go ahead.
And then on top of that, like um, like I said, I'm just like really just starting off. So as my business grows, which I expect to happen, um, things change, right?
Hmm? Yeah.
I'm sorry. Yeah. So I'm thinking like, yeah, okay. I just spelled that out for myself. Like having a an advisor like to tell me about how things are gonna work things out. Um, yeah, that sounds important right now.
Well, Terry, I'd have to agree. I mean, I'm a little biased, but I do think it's important, right? That's literally my profession. But yeah, things change, and that's a good point, right? As we're talking about, we like today's presentation, today's workshop is really just designed to get you thinking, not necessarily saying, hey, you should go do this, right? Because that depends on your individual situation. But I do think you bring up a good point, which is that your situation is constantly changing, right? Your business is growing or shrinking or evolving. What's going on in the world is evolving and changing. And so your financial plan, likewise, needs to be dynamic. It needs to be fluid, right? So, like with income protection, it's another thing most of us don't think about, right? But if we were to get sick or hurt, what happens to our business? Can it still function, right? Can it still generate income? Most people tell me, hey, Spencer, I don't plan on getting hurt. Well, of course, I don't plan on getting hurt either. I'm not going to bore you folks with statistics on this presentation, right? But I do show one, which is that 90% of long-term disabilities are caused from illness, not physical injury, right? I know we don't plan to go out and get hurt. I'm sure nobody on this call woke up today and said, you know what I plan to do is plan to go get sick, right? And yet we all know somebody who's been touched by some of these things on the screen. I hope it's not you, but I don't know, right? It might be. It might be me. It might be one of you. It might be a few of us, right? And what I've learned over the years as an advisor is we can hope for the best, but hope is not a plan, right? And again, my job is to help you create a plan where we plan for the worst. We're still going to hope for the best. And realistically, we're going to land somewhere in the middle, right? So, how do we make sure we protect the income, right? Have you taken that into account, right, in creating your business plans as you move forward? Right. Another big piece of protection, life insurance comes up often. Again, I think there's common misconceptions to life insurance that, oh, I only need life insurance if I have young children or if I have financial liabilities. Or I've heard people tell me, well, my kids are grown and I'm in retirement, so why would I need life insurance, right? I'm not here to say you do or you don't. I'm just here to say, hey, you should consider, right, that whether you're starting out or you're in retirement and everywhere in between, there is a purpose or a use for life insurance, right? On the right hand side, you can see, I also want to point out there's multiple types of life insurance. A lot of people come to me and they say, oh, life insurance, I got that, check the box years ago, I'm all set. Well, life insurance products have evolved significantly over time. And I'll show you folks later how you can use life insurance as a business planning strategy, not necessarily as a, well, if I get hit by the proverbial bus, my family gets a lot of money, right? Sure, life insurance does that, but I'll show you how not just you, but very, very large businesses also use life insurance as an asset. So we'll talk a little bit about that, right? And then sort of rounding out the protection, making sure we have those right legal documents. I know I sort of touched on that with liability, but it's not just if we get sued, right? Uh, you know, what about our estate planning? So how do we protect our families, right? Maybe you're running the business, you're the one that's helping it grow, and your spouse wants nothing to do with your business, has nothing to do with it, or your kids, right? They go do their own thing. They're not trying to be in the business. But how do we make sure that if we're not here to run it, that business can still operate or it can be sold for the benefit of, or whatever it might be, right? So that's the estate planning piece. Right? I did list out also some important financial or legal documents you want to consider having as a small business owner. Some will not apply, some, do more than others, depending on your business. Um, I always do point out the ownership and partnership agreement, especially if you have business partners. right? Even if it's your family member or your best friend from childhood, right? I always encourage business owners to have those agreements in writing because you just never know, right? And money does weird things to people, business does weird things to people. Again, talking to our attorney friends, they'll tell you it's easier to get out of a marriage than it is to get out of a bad business deal, right? So just make sure you have those documents that you agree upon it as you go forward. I know again, sometimes it's like, well, we're not super formal, we're not that stuffy, that's too high maka maka for me. No, 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 like write it down, have the agreements, because a handshake is great, but when it comes to business, you want to make sure you have your legal documents in order. It's a way to protect you, protect your business partners, protect your families, and just, make sure you have that done. The other one I always put or highlight in number 9 and 10. So if you hire employees, make sure you have an employee agreement. If you hire independent contractors, especially, right, you want to have agreements with them because a lot of times it's like, oh, hey, nephew, can you come work for me? I'll pay you, whatever for the job. Okay, great. Where's your agreement? What is the scope of that agreement? What are you paying them to do? Right? I know again it seems tedious, but these are the things that we see derail businesses all the time. It's, oh, my friend's gonna do this on a as needed basis. No need for contractor paperwork. Okay. Again, we're leaving ourselves open to risk, right? And you might deem that that risk is worth it, but just know that there's risk there, right? We're talking about this in the building block of protection. Not having these things leaves you exposed to risk, right? And having them protect you against that risk, right? So, again, not saying, how to do it or what your document should say, just encouraging you folks to look at these documents and make sure you have these things in place so that we can move on to generally the more fun stuff, right? Which is cash flow and efficient wealth management. How do we build? How do we grow? How do we move forward? Right? I think if you talk to a lot of investment managers or wealth managers or financial advisors, they'll talk to you about efficient wealth management as your allocation between stocks and bonds, your allocation between investments or asset classes, or they use fancy terms, right? For us, the first thing starts with understanding your cash flow, right? How does money come into your world? Right? This is one of those decisions I talked about. Not only do you get to decide how you're taxed as a business owner, depending on your business structure, you can choose how you pay yourself, right? If you create an LLC, you can pay yourself a salary. You can treat yourself like an S corporation, pay yourself a salary, right? And whatever additional money is left in the business at the end of the year, you can take out as a profit distribution or what we call a K1 distribution because it's listed on Form K1 of your tax return, right? Those decisions on how you pay yourself have a significant impact on your taxes. For example, anything you pay yourself through payroll as a W-2 employee, you have to pay payroll taxes on. Both the employer and the employee side of payroll tax comes out to about 15%, 15.3% when you add in Medicare and everything, right? So let's say you pay yourself a salary of $100,000, your payroll tax 15.3% of that, paying $15,300 in taxes, right? And maybe you don't have much profit at the end because you paid yourself a salary. What if you pay yourself a salary of $50,000? Now your tax is cut in half because your income was cut in half, and you have $50,000 of profit at the end of the year. You still get to pay yourself the profit because you own the business. Profit distributions are not subject to payroll tax, thereby saving yourself about seven, almost $8,000 in taxes. Right? Now, some of you might be thinking, well, that's great. Everyone should do that. Just pay yourself as little salary as possible and as high of a distribution as possible. Well, that's not always the best case either, right? Because other tax planning ideas, like your qualified business income deduction, are based on the size of your payroll. Profit doesn't hit your payroll. So maybe it's not, right? So it's a little more nuanced, right? It's understanding how all these things fit together. But the first thing we have to understand is cash flow. How does money come into your business? And how is it going into your personal life? And then how is it leaving your personal life? Right. So again, a lot going on in there. And then when it comes to efficient wealth management, we always start with just rather than, oh, you should invest in NVIDIA because tech stocks are hot, or you should avoid it because it's an AI bubble and you should invest in crypto instead. Before we even talk about that granular level of investments, right? We start with when are you going to need the money, right? If you need money in the next 6 months, you probably shouldn't invest in any of those things, right? It should go into our little short-term piggy bank here on the left, and we should be using things maybe like brokerage accounts, CDs, money market accounts, checking or savings accounts at the bank, right? If we've got a little bit of a longer time frame, maybe we don't need that money for 3 years, 5 years. Maybe we can start to look at some of those investments I mentioned. Maybe we can use certain types of life insurance that develop cash value that's available for us while we're still living. Maybe we can look at real estate as an investment vehicle, Roth IRAs, right? And then the long-term piggy bank, right? 401ks, Roth IRAs, some of those same things cross over, right? So for us, the first decision with wealth management is when do you need the money, and let's make sure we're putting it in the right piggy bank. Then we can start to dive deeper into those other levels, right? So again, just big picture, where do we go from there, right? Um, where we typically go from there is once we understand your cash flow, then one of your largest liabilities, one of the biggest expenses you pay every year is your tax bill, right? And so most people tell me, hey, I want to pay less in taxes. I don't work for the IRS. I don't report people to the IRS. My job is to try to help you keep as much money in your pocket as humanly possible without breaking any laws or rules or regulations, right? Um, but that comes down to our long-term tax planning. So kind of our fourth building block here, right? Um, I highlight tax management versus tax planning. So for anybody who has worked with a CPA, right? Would you be brave enough to share what that experience is like? Like, what do you do, right? No takers? Okay. I'll share what I did, right? What I did is I would go to my CPA and I said, hey, Mr. CPA, because my CPA was a gentleman. I said, Mr. CPA, I'd like to pay less in taxes. Here's all my financials for the year. Tell me what I can do to lower my tax bill and I'll be happy, right? So I give him my financials. My CPA would say things like, well, if you add a little bit more to the retirement account, that lowers your income. Hey, maybe you should go buy a truck because that's a deductible expense, right? And you need a vehicle, so like go buy that truck so you can transport your materials. That'll lower your income, right? So we can lower that income, lower that income, lower that income, and therefore lower the tax bill, right? I'd be like, great. I would do all those things, and a year would go by. I'd bring my financial CPA. I'd say, hey, Mr. CPA, what can I do this year, right? And every year it's the same cycle, right? Oh, go buy another truck. I'm like, I don't need another truck. I bought a truck last year. Well, you need the deduction, so go buy the truck, right? And it's like, how many trucks can I have? I mean, after a while, it just becomes ridiculous, right? And that's because all we're doing is managing the tax bill, right? There's no real planning involved in that. And I don't blame my CPA. My CPA has to do hundreds, if not thousands, of tax returns for people just like me. And I can't imagine being in an industry where I have two due dates all year, April 15th and October 15th. Every single one of your clients' returns are due. Good luck, right? So again, it's not that CPAs are bad. I'm not ragging on them. They just don't have the time to sit down with you and say, hey, let's be proactive. Let's not wait till next year when you give me the financials and we just do what little we can to manage our taxes. What if we can actually do some planning and get ahead of this, right? Quick question, right? So you can use your emojis again. There's three options, right? So I'm gonna ask everybody to vote. And the question is, do you think we are currently in a high income tax rate environment as compared to history? Do you think we're in a low income tax rate environment compared to history? Or do you think we're somewhere in the middle, right? So you have three options. It's either high, low, or somewhere in the middle. So if I could, who thinks we're in a high federal income tax rate environment currently? Anybody? Raise your hand, throw me a thumbs up if you think we're in a high environment. Okay. Yeah. Celeste, you're right. It depends on your income, but just in general, right? Where do we think the brackets are, compared to where they were historically for the same amount of income, right? So if I make $100,000 today versus if I made $100,000 50 years ago, you know, when were the taxes higher or lower? So are we high now? I got some high in the chat, right? Some people say low, some people say in the middle, right? Good. We got a pretty wide dispersion here, right? Well, the correct answer is we're actually in a pretty low tax rate environment when it comes to federal income tax. So what I'm showing you on the screen here, these are the marginal federal income tax brackets going all the way back to 1913. That's when Congress first figured out they can take money from US citizens and there's nothing we can do about it. They didn't really know what they were doing, so they took very little. The different color bars, the dark green, that's the lowest marginal bracket. don't really pay attention to that one because that means you're basically making no money. The highest are these light green bars, though, and I highlighted for us here the year 1945. In 1945, the highest marginal tax bracket was 94%. So that meant if you were in that bracket, every dollar you made, the federal government took 94 cents of it. So every additional dollar you earned, they took another 94 cents. You got to keep 6 cents. I used to say add on Hawaii state income tax, which in the highest bracket is 11%. And I'm not a math major, but 94 plus 11 is more than 100, which meant, and I was corrected because I said Hawaii state income tax. Hawaii was not a state in 1945, but if it was, and you paid state income tax at the highest level, you would actually lose money by making more money, right? Because you paid 94 cents in tax to the feds, you'd pay 11 cents to the state. For every dollar you earned, you were paying $1.05 in taxes, right? Like, I'm going to say that again. For every dollar you earned, you would owe $1.05 in taxes. You would be better off financially not making more money because after you paid your taxes, you'd end up with less, right? So, as painful as it is for me to say our highest tax bracket now is 37%, compared to 94%, that's pretty low. Right now, I highlighted the extreme, right? But look at this run here through the 50s, 60s, 70s, right? This is a 70% bracket. That's still extremely high, right? Came down to about 50% in the early 80s, right? And then we've been in a historically low tax rate environment. So, just as an example, right? If I'm that business owner and I go to my CPA who says, hey, put more money in your retirement account because you get to deduct that income. You don't have to pay this 37% today. You're going to pay income tax at some point in the future when you take money out of that retirement account, right? Does that really make sense from a long-term tax planning perspective? Well, to answer the question, I would have to know what tax brackets are going to be in the future, right? And I'd have to know what my income is going to be in the future. I don't have that crystal ball. But looking historically, right? And this is not a political statement because I think if you ask people on the left, ask people on the right, ask people in the middle, they will tell you tax brackets, taxes have to go up because it's the number one way the federal government raises money, right? And we all know currently the government is spending more money than it's bringing in. And we've all heard talk about the US debt and how it continues to grow. And at some point, we're going to have to try to balance that, right? Either cut expenses or raise income. Well, the way the government raises income again is through income taxes. So again, that's not my political leaning. That's just a fact, right? Chances are taxes are going to go up on us in the future. So then the question again becomes, does it make sense to defer when taxes are at a historically low tax rate environment compared to history, knowing that taxes are probably going to go up in the future? Does it make sense to defer a lower tax rate to pay a higher tax later down the road? I don't know, maybe, right? But the question is, have we thought that through? And for most people, the answer is no. I have not thought that through because my CPA didn't tell me to think that through because my CPA doesn't have time to tell me that because, again, they don't have time to do that type of planning. But that's the difference between long-term tax planning and just tax management each year, right? So, um, those are our 4 building blocks to success. I want to run through, again, just a couple business planning concepts, some tax planning. I'm going to fly through these, so it's going to be a lot. Um, and I realize it's going to be like drinking out of a fire hose. The goal here is not for you to like understand all of these concepts completely, but just to really get you to start thinking, hey, these are opportunities for me as a business owner. I should probably talk to a professional about this. If that's us, great. If you have advisors, great. Call them, ask them about these things, right? Our job is to just give you high level introduction. So the first business planning concept. So the first is around employee retention. I'm going to go through this one a little bit faster too, because I don't know how many of you have employees or what stage you're in the business. And then, like I mentioned, whole life as an asset class, that's that life insurance thing where we can double up, right? So the first thing, employee retention, just really, again, I'm not going to read these slides to you, but understanding that employee retention is more than just paying employees more money, right? Giving somebody a raise or a bonus is not a guarantee that they're going to stay with you. nothing is a guarantee they're going to stay with you, but that's not employee retention, right? Employee retention is really about creating customized ways to meet your employees where they are and make sure that you're providing for them in a way that makes sense to them, in a way that's meaningful to them, in a way that shows that you really care, right? And so the first thing with that is just engaging with them, right? Have you asked your employees what they do on the weekend for fun? Do you know about their family situation? And I'm not saying you need to get, into crossing any lines between, being overly invasive, but do you know your people? Right? What is meaningful to them? What is important to them? Um, I'll give you an example of a really strong employee retention program we helped our client build. He's a contractor and he used to just bonus out his guys every year, just give them a bonus every year, right? And we said, and he still had some turnover, right? Skilled labor, so it's not like easy to find. But people, somebody would come along, a bigger contractor would offer them a little bit more money and they would jump ship, right? And so he was having problems with this and he said, what can we do? And I said, well, let's just talk to all your employees, right? Are you open to us having a conversation with each and every one of them? I said, yeah. So we just said, what's important to you, right? We found out one of his guys in his free time loves to surf. Any moment he got, he'd be in the water trying to surf. Found out another one was super into photography, right? Found out another one, it was spending time with his son, right? And so we went back to our client. We said, hey, what if we took that bonus money and we actually did something that was personalized? And he said, what do you mean? So for the surfer, we went and we found a guy who shapes custom surfboards. We actually spent less than he was planning to bonus the guy, right? We had a custom surfboard shaped. He gave that to his employee who likes surfing as his Christmas bonus. For the photography guy, we went, we found a camera lens that was, again, less than we would have spent on the bonus, gave it to him, something we needed that guy didn't have, right? For the kid, right? The one with the son, right? It was finding a way. So we actually engaged with the son so that he could spend more time with his son, right? So everybody's bonus was personalized to them. And every single one of them came back and said, hey, boss, this is the most meaningful thing somebody's done for us. And one of them actually said, I was actually going to leave next year because I had a job offer from another contractor, but I can see you really care about us here. I'm going to stay. Right. And so again, the business owner actually spent less money, right? But you took the time to really engage with his employees to understand what was meaningful to them and keep them around, right? So employee retention, if you have employees, how are you engaging with them? What are you doing, right? Again, throwing money at people, giving them more benefits, 401k, saying, hey, I give you a 401k match. That should be important. No, that's not employee retention, right? Those are things that employees view as kind of like table stakes at this point. Retention is, again, really engaging with people, right? Again, like I said, going to kind of fly through these examples, right? I think the example I gave is more pertinent, but these are others. Whole life is an asset class. So I wanted to show this to you guys, right? For those of you who are saying, I don't need life insurance, maybe you don't need life insurance, but can you use life insurance to your benefit? What you see on the screen is actually the balance sheet for Bank of Hawaii. You can see it right here. This was as of year to date, June 30th of this year. This is all public information. You can find it on the FDIC website. In fact, full disclosure, I just took a screenshot of the FDIC website and I put it on as a slide, right? But what I wanted to show you is Bank of Hawaii on their balance sheet, right? So they can't lie about this stuff. They have to report this to the government, right? They own about $276 million worth of real estate and fixed assets. So that's the value of the big Bank of Hawaii tower downtown, all their branches, all the land they own, any other real estate they own. $276 million on their balance sheet. That's a lot of money. Come down a little bit further and you see their life insurance assets. They own $486 million worth of cash value life insurance, almost double. I really got to call Peter Ho and ask him to buy more life insurance so I can just say double, but it's almost double, right? They own almost twice as much life insurance as they do real estate. Why on earth would the bank do that? They're not buying life insurance to pay if, like, somebody's parent dies and gives money to their kids. Why are they doing this? It's because it's an incredibly powerful asset class for them as a business, right? This cash value of life insurance is considered a tier one asset on their balance sheet. Not to get too technical, but that means it's as good as cash in the bank. Why is that? Because by law, contractually, any dollar of cash value of life insurance has to be 100% reserved for that policyholder. What that means is the insurance company has to actually have that dollar if it's in your policy, right? Like if you go to the bank, you put your money in a bank account, they can loan out 70% of the dollars in your account. So if you have $100,000 in a savings account, the bank actually only has to hold on to $30,000 of cash. They can actually loan out the other 70. An insurance company, if you have $100,000 of cash value in their policy, they have to have $100,000 in cash. So lenders, banks, they will treat this asset as good as cash in the bank. You also have more flexibility on how you can access it, what you can use it for. You have less restriction. You don't actually have to go to a bank to borrow potentially if you have that in a policy for yourself or for your employees. So again, this is not just like some idea for small time business, right? The biggest bank in Hawaii is doing it. You can look up any bank in the country and this same dispersion will show, right? I just happen to use First Hawaiian, or I mean Bank of Hawaii. You know, the next one might be First Hawaiian. You can look at American Savings. Um, so Celeste, to your question, so you don't have to be dead. No, there are types of life insurance policies where you do not have to die to realize a benefit. You can use it while you're still living, right? So again, it's a much more diverse and flexible product that people don't necessarily realize because again they think about it just through that one lens because they don't have that coordination of advisors understanding how all these pieces work together, right? So again, the biggest banks are doing it, right? And it's not just banks, but you know, banks are pretty smart financially. If they're doing it, might be a good idea for us to consider as well, right? So those are two really quick business planning concepts. The tax ones, again, we're going to fly through. I don't expect. What about annuities? Great question, Leah. Annuities work a little bit differently. They work similarly, right? This on the balance sheet does not include annuities. This is strictly life insurance. So annuities are life insurance products that can create income for ourselves in retirement. Great vehicles as well, right? But slightly different in the context of what we're looking at here. So some tax planning concepts. Again, at best, jot these down, call your CPA, call your tax planner, call us if you have more questions, right? So a couple things you can do to help manage your tax, but also long-term plan your taxes, right? So the first is management. And tax deferrals are probably the easiest way to manage our taxes, right? One of the easiest deferrals you can do is into a retirement account. So as a business owner, again, you get to choose what type of retirement accounts are you going to offer or are you going to participate in. On the screen, you see a whole bunch here, right? With different limits as far as how much you can actually contribute, thereby kind of limiting how much of a tax deduction you can get in any given year. I know I said it might not make sense to defer your tax now to pay a higher tax later, and that's true. But it also might be true that it does make sense, right? So we have to look at both of those, right? How do we find that balance between deferring now, paying later, paying now, paying later, right? So retirement plans probably your easiest tax deferral strategy. I'm going to pay the tax, but I'll do it later, right? Ways that we can try to minimize or actually truly lower or eliminate our tax, right? So we can take deductions and depreciation, right? Depreciation is taking the value of something that we put in service that has a useful life, and we slowly say over time, this thing becomes less and less useful because I'm actually using it up. And so the value is going down. So the IRS actually allows us to depreciate the value, and we get to take that depreciation off of our income because what the IRS is saying is that, well, maybe this thing is going to be good for 10 years. And at the end of 10 years, you're actually going to have to go buy another one to replace it, right? A machine, a widget, whatever. Luckily for you, go to Y&I Value Add Product Development Center. You don't have to buy the big machine, just go use theirs, right? But if you did buy the machine, it has a useful life, it'll depreciate over time. You can deduct that off your income because you're supposed to be saving that money to buy the machine to replace it when the useful life is over, right? But that being said, depreciation is a great way to manage our tax because you're not actually losing money, right? You're just saying, hey, this thing is becoming less valuable, therefore I'm going to pay less in tax, right? With the new bill that passed in July, there's the opportunity to accelerate your depreciation, and you can potentially deduct up to 80% of the cost of something in year one. So usually you had to depreciate it over a set scale, 10 years, 17 and a half, 27 and a half. These scales were really long, but now with accelerated depreciation, you might be able to depreciate up to 80% in the first year. So consider that. The other one I want to highlight here is 199A. This is especially important for our small business owners. This is also known as the qualified business income deduction. So for those of you that are an LLC being taxed either as a sole proprietor or as an S corp, as long as you're not a C corp, this applies to you, right? You can get up to a 20% exclusion of your income from federal income tax. That is huge. So again, if I make $100,000, if I maximize 199A, that means 20,000 of my $100,000 could be excluded from having to pay income tax to the federal government, right? Huge benefit. Just to give you guys an example, I don't want to get too hung up on this chart. This says who's eligible, who's not. Most of you are probably in the non-specified service, trade, or business. Specified trade, service, or business would be things like doctors, attorneys, accountants, lawyer. I said attorneys, lawyers, right? If it's a kind of a specialized service or trade where you're selling a service rather than a product. Most of you, I think, are manufacturing goods and products and selling those. So you'd be non-specified service. So most of you will qualify, right? But again, contact somebody, figure out where you fall on these things, right? Again, I'm just showing you this to say there's planning involved, right? There are ways you can do this. This is an actual tax return from a client who came to us, right? I highlighted here line 13. So if you want to know if you're taking advantage of this, pull up your last tax return, go to line 13 of your 1040 and see what the number is, right? This client was showing zero, not taking advantage of the qualified business income deduction. Why? Partly because he wasn't sure what it really was, and two, he had a CPA who said he actually wasn't eligible. Well, we dug a little bit deeper into his situation. We actually found him a $220,000 deduction, right? Now you might say, well, my business isn't that big. Fine, we'll find a $20,000 deduction, a $2,000 deduction. It doesn't matter, right? Scale is scale, but the idea is that are you maximizing line 13 on your 1040, right? If you're not, talk to somebody about figuring out why and how you can do that, right? I want to point out some tax credits, right? If you're not aware of tax credits, credits are awesome. They're one of the best ways to mitigate your tax, right? A lot of different industries, right? I just highlighted a few that might apply to you folks, whether it's manufacturing, food and beverage, again, product manufacturing. There's tax credits out there. So please talk to your tax professional about trying to find and take advantage of these. These typically fall under R&D, research and development, right? So you might say, well, I'm just packaging mango, right? And selling it. How that's not research and development. Well, what if you create a different process to drying the mango, let's say, before you put it in the package, you might qualify for an R&D tax credit. So again, some planning has to go into this, right? But take advantage of that if possible. I know it's 12:31. We started 5 minutes late, so I'm going to take the last 4 minutes. But if you have to hop off, feel free. Tax rate arbitrage, right? So this goes back to what I was saying at the very beginning that you can actually choose your tax selection. So Terry, who mentioned he has an LLC, you can choose to be taxed as an S corp, or you can choose to be taxed as a sole proprietor. Excuse me, that's a choice you make. If you don't make a choice, the default is sole proprietor. So you've made a choice, just maybe unintentionally, right? But there are different things that can happen depending on, you know, the choice you choose to make and how you're taxed because of it, right? Last thing, I'm just going to give you guys an example of that sole prop versus S corp potential tax. A lot of numbers, don't want to dwell on it, but the idea is if you're being taxed as a sole proprietor, one thing I do know is there's no way you could pay more in income tax than you're paying now. It doesn't mean you should switch. It just means you can't possibly pay more in income tax than you are now, right? So on the left, if you're a sole proprietor, let's say your business gross is 500,000, you have $100,000 of expenses, so your taxable income, and again, this is a very overly simplified example, but your taxable income, all things being equal, is 400,000, right? Because you're a sole proprietor, you pay both sides of the self-employment tax, right? That 15.3% on this full 400,000, that's 61.2. Then you pay income tax 82, 126. So your total tax is 143. Your net income, all things being equal, 256, right? What if you make that switch to be taxed as an S corp? Same gross, 500,000. You have the same expenses, but instead you pay yourself a salary of $80,000 and you have taxable income of 320, right? Well, now as I mentioned in my previous example, you pay the payroll tax, same 15.3%, but you only have to pay it on the 80,000, the part that's flowing through payroll. So that's 12,240. You do still also have to pay income tax on that 80,000, that's 9123, right? And then you take that profit distribution, the K1 of just under 300,000. You don't get to avoid the income tax on that, right? So we still pay the same income tax, 57, but look at our total tax. It went from 143 to 78. That's potential tax savings, almost $65,000. Now, I don't want to paint too rosy of a picture. Doing the S Corp does have other administrative costs. You have to run payroll. You may have to pay some administrative fees. You do have to file an actual S Corp return. So there's other costs, right? But those costs should not add up to $65,000. So net on net, you should still come out ahead if this made sense, right? So again, not saying everybody should run out and go make that S election, just showing you possibilities, right? Again, understanding there's a lot to planning that goes into it. Just for time's sake, I'm going to skip the business planning stuff and just leave you folks with, just one slide that has kind of an idea of what organization should look like or could look like for you folks. If you haven't had the opportunity to do this, Sam, my team, we'd be happy to put something like this together so you can see what your personal and business balance sheets look like, and then make some educated financial decisions to move forward from there. So if you have any questions, you can email Sam, you can email me. If you want to schedule some time to meet with us, feel free to take a picture, scan this QR code. It'll go to a bookings link that has our calendar. And with that, I'll stop talking. I can stick around for a few more minutes if anybody has questions, but I'll turn it back over to you, Chris, to wrap us up.
All right, Spencer, really appreciate it. Yeah, just a wealth of information there. Yeah, and again, you can see both Spencer and his colleague Sam's contact info there. Thank you all for sticking around a little late beyond the half hour. Any final questions from the group? All right. Well, with that, thank you all again for joining us. And yeah, we look forward to seeing you at a future webinar or in person here at the center. Thank you again, Spencer, Sam. Really appreciate it.
Yeah, good to see y'all.
All right. Take care.
All right.